top-down analysis. There is something called top-down analysis. For those of you who are not smart money traders, if you are just an indicator-based trader, you may find this a bit strange, but then I will try as much as possible and carry you along, all right? So top-down analysis is an attempt to collapse all the different time frames into a single unit of knowledge so that at the end of the day, you're going to trade with an understanding of what we call the order flow. All right. I hope you know that the market drivers don't trade on the 5 minute. They don't trade on the 15 minute. You can have original order flow from the higher time frame, such as the weekly, daily, and even monthly. I hope you know that. So if we know this and we have that understanding, how do we now position ourselves to be able to trade in that direction? Now, order flow simply means the movement or the current direction of the markets. Now, forget about candlesticks. If I am going to show you how this chart is currently, let me go to the line charts. What can you say is the current direction of the market? Is it downward or upward? This is the weekly. You can type it. Please, I just want us to have an interactive session. What is the current direction of the markets? Upward or downward? Okay. Are we upward or downward? You see, so it is that simple to identify. Everybody knows that the market is upward. But then why is it that you end up going bullish and then you get stopped out or you lose money? That is to tell you that just knowing the overall direction of the market does not make you profitable. There are some underlying factors that you need to put in place to stand out in the market. So now I can go back to my candlesticks. Now, this is what I know. Price is always doing two things in the market. Pick your pen and your book and write it. Price is always doing two things in the market. One, price is targeting liquidity. All right? Liquidity. That is the first thing price is doing. And then two, price is balancing imbalances. Two things. These are the only things price is doing in the market. Targeting liquidity, balancing imbalances. Are you learning something? Are you guys learning something? Beautiful. So you are targeting liquidity or you are balancing imbalances. What are imbalances? Have you heard of the word fair value gap before? David Tangot, can you stop writing on my screen? Have you heard of the word fair value gaps before? If you know, you don't know what fair value gaps are, kindly type it in the comments so that I will take 3 seconds to explain that. Okay, everybody knows what a fair value gap is, right? Perfect. Kadima doesn't know what a fair value gap is. Okay, now let me show you what a fair value gap is. A fair value gap is a 3-candle price action that, let me delete this guy's writing. It's a 3-candle price action that leaves us with a gap between 3 candles. Let me show you in a sketch. For you to have a fair value gap, you need 3 candlesticks to be printed either in the same direction or in different direction. For example, if I want to tag this guy, let me give it 1, 2, 3. So I have 1, this is my first candle, this is my second candle, this is my third candle. Can you see them? So if I want to get a fair value gap between these 3 candles, I will need to carefully look out for the type of price action here and look out for this first candle. I will mark where the highest point or where the high of the candle stopped. That is the wick, right? This is the high. If you are doing your candlestick anatomy, this is the high. You see where the high stopped? And I will go to the third candle and look for where the lowest area was, or that is the wick, where the lowest area the wick traded into. This is very small. So you will realize that we don't need the number two or the second candle because we need the gap in between that second candle. So this gap or the distance between the first candle high and the third candle low is what we call the fair value gap. And it is found where the second candle is. Do you guys understand? So this type of price action is an anomaly. We are not supposed to see it. We call it liquidity void. It is void of liquidity because the market is a ground of exchange. We need buyers to sell. We need sellers to buy. So at any point price is moving, it needs equal participation of buyers and sellers. So when price leaves this type of gap, it means there is an imbalance here. So what price will attempt to do is to come back and tap into the balance, I mean, the gap before going at some point. Or price will now have a turn and completely filled up all the gaps that were left in the movement before it continue in the direction. Do you now understand what a fair value gap is? If you don't understand what a fair value gap is, you can simply go and type it on YouTube. All right. Or you can even go to my YouTube channel. Yes, I have a lot of videos there. Those of you who don't know me, you can go to YouTube and search me. Just search for Solomon King. All right. You will see a lot of videos there. So get it and get to learn Solomon King. You will see my YouTube channel there. All right. This is my YouTube channel. Many videos are there. You can go and check them. So this is what you get to see, price tapping into the imbalance. Now you realize that at some point, price will continue going until when it reaches a particular level where we have liquidity before price starts coming back. I'm digressing from what I'm supposed to teach you anyway, but then I'm supposed to lay the foundation. So in a movement, you're going to see series of fair value gaps, which price will now take time and fill up before going up. So every time you see price retracing is an attempt to fill up all fair value gaps formed. We have one, we have two, we have another one here. So you can literally see that price was taking time to retrace downward in attempt to fill up all the fair value gaps that were left on the way upward. All right. So these are fair value gaps. So when price is moving, it is either targeting liquidity. Liquidity simply means where we have people's open interest. What that means is that you will see people putting a pending order. When you buy in the market, where your stop loss is where the liquidity is. In simple word, liquidity means money in the markets. Now, assuming you are selling from here, let's say you are going bearish from this area, right? If you're going bearish from this area or somewhere here, where do you think you're going to put your stop loss? Your stop loss is going to be right above this high for an ideal trader. Your stop loss is mostly above highs and below lows. So above this high is a pool of liquidity. You're not the only one looking at this. We have pool of liquidity, pool of stop losses for other people pending order. You see it. So if price comes, it's going to target this area because this is where there is high concentration of money because the market is built on to thrive on liquidity. So every time you see the market moving, it is moving in a direction of money, moving from a direction of lower concentration of money to higher concentration of money. All right. So market is attempting to target liquidity. And what happens when price is done with liquidity? When it end up grabbing your stop losses, it will now create balance to all the imbalances. You see imbalances here? You see them? Do you see them? Are you guys with me? I hope I'm not confusing you. All right. Thank you, Evans. Yes. Thank you. I hope you guys are learning something. Are you guys learning? Let me be sure that I have guys following me. Thank you, IK. Thank you, David. Thank you, Dadex. Thank you, everyone. Thank you. Thank you. So we can now build our analysis based on this. I know I don't have all the time to do this, but then I want to show you how I trade. So I want to trade today. I want to trade today and I come to my chart. The first thing I will do is to go to the weekly time frame and establish these two things. What has price done and where is price going to? What did we say? Price is after liquidity. Can we see a high resting here? What do you think is there? Liquidity. We call them buy side liquidity. The liquidity that is resting above price level are called buy side liquidity, and they are found above old highs, and maybe if you're looking for a sell side liquidity, they are found below old lows. All right. And what happened before that? Price did well to balance this imbalance and attempted to go to attack liquidity. All right. So this is exactly the model I was teaching you. Price was done with balancing this imbalance because we are not supposed to have it there. And now it is attempting to go after money where people are putting their stop losses. All right. All the money here, it is going to go there and grab it. All right, going to go there because all the guys that have put their money here is a pool of liquidity. So this is where price is going to. You see, the money becomes a magnet for price. So if that is what I know is going to happen from the higher time frame perspective, then why not position myself in that direction? But then should I just go ahead and go bullish from here? No, you need to go into the deeper side of the top-down analysis. You don't just take the trade. Now, this is what it will bring us to the next thing. Now, drop down to the daily time frame and see what is also happening. Now, on the daily time frame, you will realize that price has been moving in that upward direction for a moment. Now, when it comes to selecting data, you have to be careful. What I mean by data is simply your past information, right? You have to be careful. As price is moving, you need to know how much of the data you need to select to be able to trade. Now, we've had a lot of instability, mixed emotions in the market recently because of the crisis happening in the Middle East. So you may wake up throughout this week, you might just see some anomaly happening in the market, and it's very possible that you may not get the directional bias correctly, but then in a normal ideal market, right? This is normally what you should see. So if I am on the daily time frame now, it's time for me to look at what is going to benefit me for the moment. Currently, what is the current direction of the market? From market structure, price is still bullish. Why? Because we've had a break of structure here. If you don't know what break of structure is, you can still go and learn online. Everything you're looking for is online, right? We have a break of structure here. So price has been moving in a bullish direction for a while. So we don't have any business selling in this market. Yes. So what do you see? Price has done something also. Can you see that there is an imbalance here which price traded into just to balance it, but then we have a buy side liquidity again in the same direction of the higher time frame buyers. This is the weekly time frame buy side liquidity, and we have found another one that is a miniature buy side liquidity. So if price is going, where do you think price is going to target? Up until now, price is still bullish in the market. I hope you're seeing it. So what should I do? I will patiently wait for an opportunity to go bullish and target this area, except if otherwise. And there are some basic things you look out for if you're looking for those kind of signature, all right? There are some basic things you look out for. So price is about to go into that direction. And we have seen that sign from all these candlesticks. We can see this exhaustion candle. It's creating that movement. And apart from that, we have a bullish order block here. I know some of you know what an order block is. Some of you don't know what an order block is. You can go and learn it online. All right. So an order block is basically where there was a huge transaction. It's from two words, order and block. Order simply means your open interest, whether to buy or sell. And block in finance simply means a large transaction such that only financial institutions can do. All right. So that is what an order block is all about. So what that means is that this area has a high potential of creating a massive turnaround from this area for the markets. All right. This is also an order block. What do we see? When price tapped into this guy, we saw a quick move out from this area back up to that level. So the same thing we are expecting here. So if I want to trade, I will now drop down to the 4-hour time frame. I'm going somewhere. Please don't misunderstand me. I am going somewhere. All right. I am going somewhere. So everything I am doing is in an attempt to reach my final destination, and that is where I will take trade in the time frame of my interest. Now I am on the 4-hour time frame. I've known that the higher time frame is about to go bullish. Everything has happened in the bullish direction. But then, what do I do now that I am seeing it on the 4-hour time frame? Do you know that you can take time and trade something I call counter trade while you wait for the higher time frame to prepare for the overall movement? Counter trade simply means you're taking an opportunity of the retracement from a bigger movement. Let's say you have a movement like this, all right? At every push, you will expect a retracement, right? So this retracement, let's say this is the weekly time frame, and the retracement is going to be shown on the 4-hour. Do you know that the retracement is going to create something like this on the 4-hour? So while you're preparing for a buy, somebody is already selling and making money from the retracement. So in essence, almost everybody in the market is a counter trader. Sinus, the order block is simply the last uh, bullish candle, I mean sell candle in that direction. You know, most people want to confuse their understanding of an order block. Let me show you what an order block is. Can you see this sell candle where the last sell candle happened? Basically where the last massive sell candle was. This is a bullish order block. Why? Because we saw price turning back from there. And there are some things that you can also mix or you can combine with another block to call it a high probability order block, such as finding imbalances close to it, and you need to see the order block creating a kind of a massive movement around it, like giving a break of structure and so on and so forth, right? So we have an imbalance close to the order block here, and prior to that, price actually create a break of structure. So this order block is actually a high probability order block. That's why we saw price tapping it and it quickly left that area. You can go on YouTube and search high probability order block. You may even see my videos, all right? But then we are looking for an opportunity to take today's trade. So when I come here, I'll realize that price is more of a bearish guy on the lower time frame as opposed to a bullish guy. All right, as opposed to a bullish guy. So do you know that at a moment, since yesterday, we've had a bearish movement on the 4-hour time frame on gold? And maybe because of the crisis happening currently in the Middle East. But then this is enough movement for somebody to create this surge into the lower time frame and take advantage of that. But then if you want to go with the higher time frame buyers, you must be patient. Now, this is where the most important knowledge you're looking for is. Patiently wait for a shift in market structure. Remember, on the higher time frame, we've had price traded into what? Into a bullish order block. We are still bullish, but then on the 4-hour time frame, for us to have a bullish movement, we need a shift in market structure in the bullish direction to establish that fact. So we can see that there was a shift in market structure here, but then another thing is also there. Remember, we're talking about high probability trade setups. Another thing is also a factor here. This shifting structure came in with a struggling candlesticks. Do you see them? A shifting structure that has a very high probability of turning price upward should give you that energy in the shift. Can you compare this one? We've had just one candle closing above this one and it went up heavily as opposed to this one. We've had a lot of struggling candlesticks here as opposed to that one. So this is more scary than this one. You can easily take trade with this because you know this candlestick came in with at least considerable energy. And if somebody is taking trade from here, it becomes a high probability trade level because we've had that shift in structure in the same direction of the higher time frame. So taking a trade from here has a lesser risk than when you see a struggling candlestick, something like this. So if I were you, I would still be careful. All right. Let me also tell you that throughout this week, I only took one trade. Why? Because I am trying to be careful. It's another way to stay away from trouble in the markets. When you see heavy fundamentals coming in the market, you need to know when to stay away from the market. You see, it's not only knowing how to take trade that makes you a trader. Knowing when not to take trade is also a skill that every trader should learn. All right? Should learn. So if I were to take trade here, trust me, guys, I'm not going to take this buy. I'm not going to take this buy simply because I can see struggling candles. Struggling candles are coming in. So in essence, if I was to take trade today, I will simply do this to gold. I will call it an X, no go for trade. All right. Why? Because it has a mixed reaction there. All right. It has a mixed reaction there. Or mixed sentiment rather, not reaction, sentiment. So knowing the types of trade you're supposed to take and the ones you're not supposed to take is also very important. All right. So kindly just exit. Look for another pair to trade. It's not most that you must trade. All right. It's not most that you should trade. It's because you know why prop firms are thriving in this industry. Do you know why? Guys, please can you tell me in the comments, why do you think prop firms are making a lot of money in this industry? Proprietary firms. You guys know what a proprietary firm is, right? What do you think is the reason why they make money? If you know that answer, type it in the comment. Why do you think they make a lot of money? Are you guys with me? Because of incompetent traders, Mr. Steve, it's true. People that buy their products fail. It's also true. What else? I don't have an idea. Thank you, Dadex. You are you are sincere. When you lose money because of they give big equity, they leverage on lack of our risks, impatient traders. Now, there is only one reason for that. There is only one reason for that. They have introduced what you don't have, rules. Do you have a trading rule? They know that 98% of traders don't respect their trading rules. So they've thought, okay, if we give these guys rules, they will always break it. They tell you that you have a daily drawdown of 3 or 5%, right? Maximum drawdown of 10%. And you have been trading for 10 years without rules for your trading journey. And here is a new, uh, uh, is it a bait now? A bait. You know what a bait is, right? Somebody came with a bait and told you that if you can stick to the rules here, we're going to give you 100K live account. And because you are not used to having rules in your trading, you are used to funding account and losing. So they make money because they know you don't have a rule, such as saying, today is not for trade because I can't see what I'm looking for. There is no deadline in most prof accounts now. Yes, that's true. They capitalize on impatience. They have come with rules. Write it there. So what happens when you are used to trading with rules? You will thrive at any given moment. The only inspiration you have out there is an Instagram trader. That's why you're always impatient. You are a trader, you are not a gambler. Don't forget this. So have a set of rules that these are the things I look for. If it doesn't go in the direction, if it doesn't give me this, I am not going to go. But some of you will insist that you take trade whether price gives you that or it doesn't give you. And it's bad. It's the reason why you are always losing money in the markets. Are you together with me? So I will simply not trade today. In fact, earlier today, I even saw an opportunity on the 1 hour time frame, but then I refused to take the trade simply because, let me show you, I didn't have a confirmation. I have something called confirmation or confirmatory entry. Look at this. I saw this today. Part of my rules is to always trade with confirmation, right? I saw this. Can you see a break of structure on the 1 hour? You see it, and there is a fair value gap. That's an imbalance right here. Am I not supposed to take trade here to go bullish? Is that not what I'm supposed to do, guys? And target what? I can see that there is also a liquidity here. Since I'm done with that imbalance, I can target this liquidity as my take profit. But then I refuse to enter from here because there was no confirmation for me. Maybe I will recommend you go and check, just search my YouTube channel and check entry confirmation. You're going to see all the entry confirmations there. All right. There is no confirmation. So before I take trade, I have a rule, and that rule must be met at least 98%. You see, every time you violate your trading rules and standard, you will not be able to stand in the market. The market is not that difficult though. It is because it thrives on emotion. That is why you're finding it difficult. Hmm? I started by telling you that a lot of people make money in demo accounts, right? But then what happens when it comes to live account? It is simply because energy is the one controlling it from that moment. All right. Mr. Tonge, as soon as my time is up, you can let me know. All right. You can just send me a message on WhatsApp. I think I need to know how much or how long I'm supposed to speak or to teach you guys. Are you guys with me? Okay. Yes, you lose money. I hate losing money in the markets. Hence the reason why I had to do it correctly. One of my mentors told me this earlier when I was starting. He says the reason why a lot of traders don't make money in the market is because we lack education. We lack education. If you find somebody to educate you on the psychology of money, you will know how to approach trading. All right. By the time you start building your trading account from a percentage-based system, you will be delivered from losing unnecessarily in the markets. I used to ask people this question. If you funded $100 this week and you closed the week with $103, were you profitable that week or not profitable? Go and search me on YouTube, Solomon King. Almost everybody, most traders know me. All right. Do you guys see this? If you guys did not respond to my question, if you funded $100 and you closed the week with $103, were you profitable or not profitable? How many percent have you made? Not profitable? Somebody said not profitable. Wow. That's serious. Little profit. Okay, that's good. I now see where the inspiration of many traders are coming from. Somebody said not profitable. Yeah, it's good. The problem is that those of you that are overexcited with account flipping, by the time you will end up doing one account flipping, you will have given your money time and again to the markets. I am telling you the sincere truth. And trust me, you will still come back and meet us in this market. If you don't see profitability in that percentage level, some of you are after from 100 to $200, right? From 200 to $400. How long can you consistently do that? There is always going to be that thing called losing streak or losing days. What will save you in those days is your money management. All right? It's your money management. There is a reason why you have leverage in the market. There is a reason why you have money management in the market. Now, assuming, okay, let me take the figure to $1 million. If you have a $1 million account and you end up making 3% at the end of the week, how much have you made as a trader? That's like $30,000, right? That is like $30,000. So the problem is not the market. The problem is your perception about money. That's why I say many of you are just coming from most of your inspiration is coming from Instagram traders. You know, those days when we started trading in the Forex market, when you see people that make $50,000 annually, it was a big deal. All right. Do you know that if you meet a serious investor and you showed your investor maybe your trading history and what you're showing your investor is 30% monthly return, you will never get any investment from that investor, a serious one, because it's not realistic. That I am telling you the idea of trading with percentage. When you trade with understanding of percentage, you will trade in this market without blowing account forever. I have students I've mentored and I've taught these things. Let me show you one of my students. I think, what's that his name? Time and again, because of this same mindset, this guy has been consistently making withdrawals. Can you see? Every time he makes withdrawal in a prop account, he sends me a screenshot of that withdrawal. He was tired of losing. And at some point, when I told him the secret of building an account is a percentage based growth, this guy was delivered from excessive losses. Excessive losses. Thank you, Godwin. Thank you, Amos. Yes, I see. I see guys. You know, I see some of the guys that are overexcited that 3% is not profitable. It's little profit. All right. You will understand what it means. I don't know where you're getting your money to fund your account, but when I started trading, I struggled to get money to fund my account. So I had to do my best to protect the money. All right. So let's go back to the second thing. Let's analyze GBP JPY. I think this should be the last thing I should do. Was it day before yesterday? I actually took a trade on GBP JPY. Let me show you the trade first before I show you. This is my private community. You can see this was the trade, but then prior to that, this was the trade setup. Can you see it? That was the trade setup. But then let me go back to where I took the trade from. So let's start from the weekly time frame. All right, start from the weekly time frame. Now, if you're analyzing GBP JPY or JPYPS, there's something called the yen basket. How many of you know the yen basket? The yen basket is the benchmark asset, is the index that measures, is the index for the Japanese yen. So if you are trading any Japanese yen or any of the yen pairs, you must do your top-down analysis on the yen basket to know where the yen basket is going before you can trade it. So you normally should go to the yen basket. All right. The yen basket is found on TradingView. You can search for it. So the yen basket is this guy. If you know where the yen basket is going, then you'll be able to trade in the direction of the yen basket. So the yen basket is currently bearish on the weekly, and you can do analysis to know where the yen basket is going to. So before taking that trade, I saw that the yen basket was bearish. And that means if I am trading GBP JPY, what should I do? I should go bullish on GBP JPY because JPY means it's weak if I'm going bullish, right? And the yen basket is weak. That is to say the JPY is going to be weak, all right? Now, with that understanding, you can go to GBP JPY and now start your top-down analysis and analyze the chart in that direction. So I have seen that happening. And prior to that, I had price trading into this liquidity area. We have this entire liquidity pool resting above here. Let me take it up to this guy. We saw price closing above that guy, but then we have closed above this area. We left an imbalance here, which I'm still expecting price to come back to. But then prior to that, I saw an opportunity on the 4-hour time frame. Sorry, was that what I saw? Let me go to the weekly. There is something I saw very precise. Beautiful. I saw that the weekly was attempting to go into this buy side liquidity also from the overall target, right? That was what I saw price attempting to do. Now I know that price is going to go bullish on GBP JPY and the yen basket is going to go bearish as expected from the yen basket, right? Now on the 4-hour time frame, there was a very, very powerful level I'm seeing. I was still seeing, and it was this area. I saw a miniature buy side liquidity here because it happened around here. Everything happened around here. We have a miniature buy side liquidity resting at this point, and I wasn't expecting price to retrace all the way down here. Why? Because I'm still expecting price to go into that guy because the yen basket is printing bearish. So I was using this fair value gap as my support level. I just expected price to trade into this fair value gap, fill it up, and then trade into, let me mark this fair value gap correctly, into the buy side liquidity. All right. So when I saw this, I was preparing for the bullish movement. And I have to go down to the lower time frame to have that confirmation. Price has tapped into my fair value gap. Now I drop down to the 15-minute time frame because I was trading within a session of the day. Now, when I saw this, I was about to enter the trade, but I was waiting for a confirmation. Everything here was a bearish movement on the 15-minute time frame. I am expecting to see a bullish movement or a bullish sign so that I can trade in the bullish direction. It minimizes the risks. So that was when I saw a shift in market structure bullish. Boom, and it came in. Can you see price closing above this area? That was the exact model I normally trade when I come to trade in the market using this simple approach. So what do you do? After that, my entry was carefully placed at this level, this fair value gap. I said imbalances. We are done with this area. We want to come down to this imbalance. And I went long from here at this point, and my stop loss was right below this guy, and I was targeting this buy side liquidity. That was what I did. All right. That was a trade. Okay, my stop loss was there. That's a trade of, that's like 1 is to, is that 1 is to ratio 2.6? That's like 1 is to 3. or thereabout. All right. That was the trade that I took. It took almost a day for that trade to become a reality, almost gotten stopped out. But then it finally played out in that direction. So that is one of the ways I take trades. Sometimes it plays out perfectly without any challenge. Sometimes you'll have to stay through all these struggles and it will finally play in your direction. You see how it played out? It was supposed to play out smoothly without this, chop, 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 chop around here. That's the trade, the kind of trades I take most of the time. And there are two things that happens to you when you take trade. It is either you get stopped out or you end up making money in the trade. What you're supposed to do is to do your money management correctly before going into the trade. And that's the only way to stay out of trouble. Make sure you don't jump money management and you will have another opportunity to trade tomorrow. So your insurance or your guarantee for the next trade is your money management. If you risk everything you have in one trade, you are simply telling the market, I am not willing to trade tomorrow, or I'm not ready to trade tomorrow. Are you guys with me? Mm, Let me give you a little tip on how to grow account. Yes, growing account, it requires patience. So that's why I say you must master your craft. Test or back test your strategy. If you see how good it is, with with 40% win rate, you can grow an account. Yes, with 40% win rate, you can grow an account. Trust me, I've done it severally. I've done it severally. I don't want to show you some things because this is a platform I am opportune to come and teach. But then these are the things you get to do every time you trade in the markets. There are people making a lot of money quietly in this market simply because they have gotten an understanding of this market. All right. So this is all I have for you guys today. Mm. Yes, I try as much as possible to avoid trading news. All right. I avoid five different news: FOMC, NFP, CPI, interest rates, and employment news. All these type of news can affect your trading. And I don't have that kind of a psychology of staying in the market and see how market um play with my emotions. So it's better I don't trade when there are high impact news. All right. So that is it, guys. I think I have said enough. Um, Mr. Tonye, you can take over from here. I appreciate the opportunity.
Oh, thank you so much, Mr. Kings.
Thank
Thank
you,
you so
sir.
much. Thank you so much. A lot of questions are still okay. I think it's appreciation than questions. Uh, okay, let's see. Okay, you've answered that of fundamental. Okay, all the other ones are appreciations. Okay, somebody is asking, while waiting for confirmation, do you also consider other block? Vicdon. Uh,
Mm, okay.
so one question that has been consistent, Mr. Kings, is the question of how do you get to know the fair value gap that work? I think I've seen that question like two times now. How do you get to
Okay.
know the fair value gap that will work?
All right. All right. Thank you. Thank you. So, guys, there is something called there's something called the PDRA. All right. These are ICT terms. If you know what ICT is, you should know what that is. So the PDRA is basically a sequential arrangement of the institutional reference points. If these words sound too technical for you, you can go and search for them. All right. Now, if I look at price moving from here to here, if I am doing something from here to here, you realize that I have so many fair value gaps on that on my way downward if price was coming downward, right? I have one here, I have one here, I have one here, I have one here, right? So which of these ones should I take trade from? It is possible you want to take trade from this one, right? This first one, and you get stopped out. You move down to the second one, you get stopped out. Move down to the third one, you get stopped out. Now that is where the understanding of the premium and discount array comes in handy. So from today, every time you're taking trade, take your Fibonacci tool, measure from the lowest area, that's the swing low, to the swing high. Anything, if you're going bullish, anything above the 50% of your Fibonacci tool should not be used for an entry. Focus on the second part, that is from 50 to 100. This is the area to take trade. It is a discount area. How many of you love to buy things expensively? Everybody wants to buy something cheap because the attempt or the goal for every businessman is to make as much profit as he can. So buying something at a lesser price, selling at a higher price makes more money than buying higher, selling higher, right? So everybody in the market is trying to make enough money when they buy lower. So imagine this is a scale of measurement for a price. Somebody is buying an orange from this level at the rate of $100 per orange. All right. And somebody is buying here at $10 per orange. And price decides to go up to 120, and all of them sold it. Who do you think will make more money? The person that bought from $10, right? So that is what the smart money are doing. They are trying as much as possible to buy at a cheaper price so that by the time price goes up, they can offload it and sell it at a higher price. They will make more profit. That's why they are patient for price to come down. So the fair value gap that will work is the fair value gap that is found mostly at the bottom, mostly in confluence with other institutional reference points. These are things you may want to go to learn on YouTube. You can see another block close to it. You can see a fair value gap. You can see a mitigate, a breaker block. All these are confluences that you can use for the entry for going in that direction. Do you understand? Do you guys understand? Yes. Thank you. Thank you, guys.
All right. Thank you so much. Thank you so much, Mr. Kings. Let me see. A lot of them are asking questions, but I think we'll just call it a day here. So guys, I
Thank
think we get that very clearly. A very simple, straight to the point explanation. So for those of you asking, how can you find the fair value gap that works or the point that works? Okay. That has been also clarified. Okay. So yes, the YouTube channel, please go to YouTube and search Solomon Kings. Okay, go to YouTube and search Solomon Kings. Sir, if you have your YouTube channel link, also you can drop it in the comment section. Okay. So thank you so much, Sir Kings. Thank you so much. Guys, what do we say to Mr. Solomon? What do we say to him? What do we say to him, guys? Okay. What do we say to him? What do we say to him? Yeah. So keep that appreciation coming in. Keep that appreciation coming in. Keep that appreciation coming in. Wonderful. All right. So thank you so much, Sir Kings. We really appreciate your coming. Myself and the entire EQ Markets Global family. We really appreciate you coming, sharing your wealth of experience with members of our community. Thank you so much, and God bless you real good. Thank you so much. So guys, it's been an amazing time from Monday up until today. On Monday, we had Mr. Priye Ozenabo, and he did amazing well. In fact, Monday was so power packed, and we learned a lot of things. I know one of the key things, or one of the highlights of what we learned on Monday was trading with old numbers. And then, man, I knew old numbers a bit, but I did not know it the way Priye understood it and explained to us. When I went back, do you know that right now in all my tradings before I enter a market, I use old number as part of my confluence. Most times the most profitable trades that they happen either at the old numbers or they happen close to the old numbers. Amazing. One of the major highlights for Monday. And then on Tuesday, we talked about risk to reward ratio. And then we learned how to manage our risk. And that was taken by Mr. Michael Obi. Also perfect. Also awesome. Powerful session. Powerful session. On Wednesday, which is yesterday, we had my friend Peace Doyle all the way from Nairobi, Kenya. And yesterday, he shared with us some amazing stuff, how we can find demand and supply. And in fact, yesterday was mind blowing. All right, how to find the demand, how to find supply, so that you don't get to miss your entries or you don't get to be stuck. All right, and it was a really really powerful sessions. We considered a lot of live trading scenarios and conditions. And then today, which is day 4, we've also had Solomon Kings share with us how to find A plus setups, especially delving into smart money concepts and breaking it down into smart money systems and trade strategies. Super amazing. All right, he has showed you how you can find the liquidity sweep and then the market structure shift. Okay, after the market structure shift, he has also shown you how he uses fair value gap, um the fair value gap to enter trades. And most especially for those of you asking, how do you know the fair value gap that works? All right. He has also gone ahead to teach you or mention about PDRA, okay, the premium discount arrangement. And then he has said that if you are looking to buy, do not enter any fair value gap that is above your 50% Fibonacci level. That would be crazy. That would be madness, honestly. But come to think of it, I think it will be madness. All right. And that you're going to use a fair value gap or even an order block that is not within your premium discount levels. Okay, so it's one perfect way to find the reference point that is the fair value gap or other blocks that works. All right, so amazing. All of these videos will be made available, okay, after